Am I the only one that didn't know how wild the financial markets can get? Please like, subscribe, and share this video. Hold on tight, because this week has been a wild ride in the financial markets. We've got trade wars heating up, interest rates bouncing around, and consumer confidence taking a hit. But don't worry, I'm here to break it all down for you. We'll cover the big stories, what they mean for your wallet, and what you should be doing with your money. Let's dive in. This week saw some major developments in the ongoing trade war between the US and China. We also saw some key economic indicators released, giving us a glimpse into the health of the US economy. And as always, the Federal Reserve is keeping a close eye on everything, ready to step in if things get too out of control. The markets hate uncertainty, and this week provided a heaping dose of it. The trade war escalation has businesses and investors on edge, unsure of what the future holds. This uncertainty is reflected in the volatility we're seeing in the stock market. So, what does this all mean for you? Well, if you're a consumer, you might start to see prices creeping up on some of your favorite goods. And if you're an investor, it's more important than ever to have a solid plan and stick to it. The trade war between the US and China continues to make headlines, and this week was no exception. The two economic superpowers exchanged blows, with each side imposing new tariffs on billions of dollars worth of goods. This tit-for-tat battle is having a ripple effect across the global economy, causing uncertainty and volatility in the markets. For US consumers, the tariffs mean higher prices on a wide range of products, from electronics and appliances to clothing and toys. This is because many of these goods are either manufactured in China or rely on components sourced from China. The tariffs are essentially a tax on imports, and those costs are being passed along to consumers. On the business front, the trade war is creating headaches for companies that rely on global supply chains. Many companies are now facing higher costs for raw materials and components, and they're also dealing with disruptions to their supply chains. Some companies are starting to shift production out of China to avoid the tariffs, but this is a costly and time-consuming process. The trade war is a complex issue with no easy solutions. Both the US and China have valid concerns, and it's unclear how or when this dispute will be resolved. In the meantime, businesses and consumers are left to navigate the uncertainty and volatility. The stock market has been on a wild ride lately, and this week was no different. The major indexes swung up and down as investors reacted to the latest headlines on the trade war and other economic news. This volatility is a clear sign that investors are feeling uncertain about the future direction of the economy. One of the biggest drivers of market volatility this week was the surge in mortgage rates. The average rate on a 30-year fixed-rate mortgage jumped to its highest level in years, fueled by concerns about inflation and the trade war. This sharp rise in rates could put a damper on the housing market, as it becomes more expensive for borrowers to take out a mortgage. Adding to the market's woes was a string of disappointing earnings reports from some major companies. This is a sign that the trade war and slowing global growth may be starting to weigh on corporate profits. When companies start to feel the pinch, they often cut back on investment and hiring, which can further slow economic growth. So, what does this all mean for investors? Well, it's a reminder that the market can be a volatile place, and it's important to be prepared for ups and downs. If you're feeling nervous about the market, it's always a good idea to talk to a financial advisor. They can help you create a portfolio that's aligned with your risk tolerance and financial goals. Beyond the headlines and market swings, there are a number of economic indicators that provide a more nuanced view of the health of the US economy. This week, we saw a mixed bag of data, with some indicators pointing to continued growth, while others suggested that the economy may be losing steam. One of the most closely watched indicators is the Consumer Price Index, which measures inflation. The CPI rose modestly in March, indicating that inflation remains in check. However, core CPI, which excludes volatile food and energy prices, rose at a faster pace, suggesting that underlying inflation pressures may be building. Another important indicator is consumer confidence. The Conference Board's Consumer Confidence Index fell sharply in April, hitting its lowest level in months. This decline was driven by concerns about the trade war, rising prices, and the overall direction of the economy. When consumers are feeling less confident, they tend to spend less, which can slow economic growth. On a more positive note, The labor market remains strong, with the unemployment rate hovering near historic lows. This is a sign that businesses are still hiring and the economy is continuing to create jobs. However, wage growth remains sluggish, which is a concern for many workers who are struggling to keep up with the rising cost of living. If you enjoyed this video, don't forget to like, subscribe, and share. Your support helps us bring you more great content.